Right, today what I'm going to show you is 3 things that professional traders do differently to retail traders. In doing this, hopefully I'll give you some insight into how that you can improve your own approach and how you can get an idea of what these pros are doing, because essentially professionals are no different in their ability to predict what's going to happen. People have this illusion that professionals have an unbelievable win rate, that they know what's going to happen. They don't. They're no better than you or anybody else at predicting where the market's going to go. Where they're better is the way that they apply the trades that they take on. Number one thing that professionals do different to retail traders. What they do is they trade the situation and not the setup. So what I mean by this is many traders learn a setup. They learn how to trade a certain specific trade, a flag break, for example. And they look for this in every iteration. Every time they see it, they trade it. The problem with this is that if you don't appreciate from the bigger picture how the market's structured, you're running yourself into a problem, because you're now trying to trade a flag break on a day that it's unlikely to break out. So there's your problem to start with. I kind of always see this as an analogy of turning up at a building site. You're going to build something and you turn up with a hammer because you know how to use a hammer. That's your setup. That's great. You know how to use a hammer. But if today you're installing windows, that hammer is going to be absolutely useless. You want to turn up on demolition day. That's when the hammer is going to be useful. This is what professionals do. They understand what tools and when to trade in certain ways. So I'll give you an example. This was the gold breakdown a couple of days ago, and understanding how on this day playing a breakout was worth it. On the days preceding it, it was not. Go and have a quick look at this. And what we've got here is on the left hand side of the chart, you can see there's a reasonable move down. Now, you get a very simple flag break type trade that comes in just here. You get the drop, flag, breakdown. And that's the end of that initial move. And straight from this point, even on that flag break, you see volume start dropping off. So as soon as you're starting to see that, what pros are doing is they're looking at this and saying to themselves, right, market is unlikely now to just suddenly start to go again. Instead, they then become more inclined towards trading more range-bound trades, more inclined to try and buy into any dips, because the market doesn't have the overall bigger picture idea of where exactly it can go. So then you're looking for clues. And this is what's happening then, is from the bigger picture, you're waiting for something that says, yes, now today's the day. And this is what we then got. Throughout this week, you get an attempt to break the range towards the upside, which fails. Straight away now, this is opening up the possibility that maybe there's a trend situation coming on here. So now you can bring out those flag break trades. Now you can bring out the hammer, if you will, to use the previous analogy. Now you can start looking for the breakout of the range. You get a little flag that comes in here. This flag all of a sudden has got so much more power because you're trading the situation. The situation is a false breakout to the high in what is already a slightly bearish market. So therefore, now you can start thinking this is going down. The flag has so much more value now because it offers the chance to get short. And then you can also do what most people don't like doing. Again, this is something that a professional trader is willing to do. Sell the low, because you've got the chance for a breakout. Volumes are starting to increase as the market fails to the upside, as it starts to come off, certainly compared to previous. So now it's saying there is energy in the market. There's a willingness of people to move. Now you can play the break towards the downside. So that's the first difference. That's one way that pros do things differently. They trade the situation. They don't trade the setup. They look from the top down and then say to themselves, how's the best way to trade today? Next thing that they do as well, and this is where people feel that, pros are so much better at predicting lows and predicting highs. They don't. Your job as a trader is not to try and predict the high or the low of the day. There's a certain degree of arrogance in trying to do so. If you think that you can predict the low of the day, i.e. guess where the low is, what you're doing is you're assuming that you understand the thinking of all the other thousands of people that are trading that market. And not only do you have an idea of where you think the low is, you also believe that you know where everybody else thinks the low is, therefore you can pick it. There's no point in doing that. Nobody understands what everybody else is thinking. So there's no value in doing this. Your job as a trader is to look at a move and say, right, I now believe that we have established a low and we are now moving up. Essentially, the easy part of a trade is the middle part. The bottom 10% where you work out that a low's been formed, and the top 10% where you work out where the move's ended, is the hard bit, because that's the bit where people are trying to re-establish position. You're getting this battle of buyers and sellers to decide which way the market's going to go. But once, let's say on a reversal up, buyers have taken control, that middle part of the move, as the market moves up until we find new sellers, That's the easy bit. That's the bit that you want to be involved in. So what professionals are doing is they're not looking at trying to guess the low, because that's the hard part of the trade. Even if you guess the low, chances are you're going to sit for a long period of time questioning whether you've actually got the low, because the market doesn't suddenly V-reverse, which is what everybody thinks is going to happen when they buy the low. So instead, they wait for the point where they can say, yep, I know where the low is now. I know it's below me. That doesn't matter. Your stop can go below that. That's what the low gives you, your stop. But now you can play the clean part of the move as the market reverses back up. That's the simple basis of how professionals call a low. They don't predict the low. They wait for it to turn. You wait for the market to tell you it's turned. It shows a pattern. It shows you that a low is established. You've seen the hallmarks of a low establish. And we'll do another video on this on another day, how to spot a low. And then you trade the meat of the move, the easy, clean part of the move. That's what you want to be trading. That's what they're after, not trying to guess a low. There's no value in guessing a low. It's an ego trade. It's wonderful. You can say, yeah, I bought the low. Chances are, and this happens to so many people, even if they get the low, they get out 5 ticks above and then wonder why they weren't in for the next 50. And all of that is because if you predict the low, you don't know it's the low until it's turned, and you doubt yourself as it starts to bounce and stall as you're waiting for buyers to overwhelm sellers and the move to then rise towards the upside. You don't need to be part of that. Let it show you the low, then you can play the meat of the move back up. That's the easy bit of the trade. That's the clean part of the move. Final thing that I'm going to show you is then the other key difference. Most new traders, what they do is they trade all trades the same. I.e., they have a set size that they use and they say, right, I trade a 2 lot, for example, and that's what they trade. And they don't vary this. What professionals do is they vary size with conviction. If your conviction goes up, you put more size on the trade. And the simple basis of this is that as probabilities of your trade increase, i.e. probability of your trade working increases, this is now the point where you should be taking on more risk. You should be adding size to your trade, because you're being shown by what's going on that you are right, that this market is going to do what you think it's going to do. So now it's the time to look at it and say, I'm going to get paid. So in terms of a professional being better at predicting what's going on, they're not. But what they're doing is, as they see that what everybody else sees is going on is starting to happen, they then see that this gives you asymmetry. The high breaks, in this example, this is just a simple 1 minute breakout through a 60-minute level, which is at 98.9. Nice, simple breakout. But what's going on here is most people trading this look at the trade and they go, right, let's see if I can get in before the break. They buy it down here, and as it breaks, they go, oh, that's good. Now I'm on side. This is nice. I'm happy with this. Move their stop to a scratch and hope that it just runs and runs and runs. What professionals are doing is they're looking at this and they're now saying to themselves, right, I've got a level up at 05. This is highly likely to go now because there is nothing in the way. This is where I need to add on. And as long as they can see other people participating, other people buying, this is the chance. This is the chance to leverage your position up. And that's what they do differently. That's how they vary trades, and they allow themselves then to make the most of these types of trades. They get paid more on these trades so that the ones that don't work, they do on less size. It doesn't cost them so much. They do, if they enter with 2 initially and the trade doesn't work, they lose on 2 lots. But at the point where the chance of it failing is very, very low, they increase size, because now it's unlikely to go wrong. It's much more likely to work. So now you can add size onto the trade. So you're using the situation and in particular order flow. And if I show you this, you'll see what I mean. As you start to get this bid up, enter the trade at 96.1, the market starts to push up. At this point, professionals aren't looking at this and thinking, oh, I'm quite pleased with this. Yeah, let's wait. Let's see what happens. Let's see if this goes. They're already saying to themselves, right, people are buying this. You can see that on the order flow. Now's the time to add on. Now's the time to increase position, because now this is highly likely to go. Because it's not just a technical trade that you've got some kind of previous tested probabilities on. This is a technical trade where you're able to say to yourself, not only do I think that this has got a high likelihood of working from previous experience, you're also seeing that other people are doing it. And this is what I mean by not trying to predict what other people are doing, but instead when you see that other people are buying, now you want to get involved. You can start to buy above 96. Remember, the break is at 98.9. This is what people are already looking at. They're already looking at 98.9 thinking, right, if this goes through there, add again. This is the chance to really leverage your position up, because now the trade has become asymmetric. And I know that we had a discussion on this recently, but we were asking about asymmetry in trades and scalping. Absolutely, this is where the trade becomes asymmetric. This is where you're not guaranteed to win. You never are. But you're able to say to yourself, the chance of me winning has now gone way up. I want to add on to this trade further. And there you see, boom, jumps. In that situation, you don't get the chance to add just there. We jump to a higher point, and straight away you can now start to try and add even higher up. It's not about thinking, oh, thank goodness, and the relief of getting out of the trade. It's about thinking to yourself, can I get more on this? Clearly people want to buy, so I want to get involved. I want to join them in this because I already think the market's going up anyway. And now I'm getting shown that other people think the same. If other people are willing to buy, they push price up. This is what professionals are looking for. They're not sitting there thinking, oh, wow, that was a nice surprise. We've got to my target quicker than I thought. Instead, they're looking at this and saying to themselves, this is the chance to add. This is where I can really get paid on this trade. And if they're looking up towards 04, 05, you start pushing up there, then they start to get out of the trade. It's about not just having an expectation what can happen. It's about seeing that when the market shows you it's about to happen or it's happening, you build your position up, you leverage your trade up. And this is how you can get that exceptional growth on certain types of trades. It's not that they start off any better in their prediction of what's going on. It's that they realize that the trade is going to work, that it's got the hallmarks of moving, that people are buying, it's become asymmetric. Now you add and add and add. That's how you leverage your position. That's what pros do differently. So there you have it. 3 things that professional traders do different to most retail traders. These are the 3 things that make a key difference in performance. It's not that they're better at predicting what goes on. It's that they're better at recognizing it and also understanding where the real value is in those trades and leveraging those positions up when they get the chance. If you enjoyed that video, hit like, subscribe to our channel and hit that notification button. If you do that, any new videos that come out, you're going to get them fresh off the press. So look out for those coming up in the near future.